sitting in the shade today because someone planted a tree a long time ago. Hi and welcome to RD360 Money Making Maxims. America has Washington DC, India has New Delhi, but the capital city for all fundamental analysts is an intellectual village called Graham, Dodd and Buffettsville. The mayor of that village, by popular claim, will always be a man called Benjamin Graham. Benjamin Graham, the father of modern security analysts, wore many hats: an economist, an investor, an author, a teacher. He was a towering intellectual. Joining me to discuss the life and sayings of Benjamin Graham are two of the finest fundamental analysts and practitioners of Graham way of investing: Sanjoy Bhattacharya of Fortuna Capital and Chetan Parekh of GT Investments. Gentlemen, welcome to the show.
Thank you.
Thank you.
Sanjoy, is Graham still a religion in stock markets?
I wouldn't say that. In fact, I think now we've come to the stage because of the tremendous success that Buffett has enjoyed, and I think the fact that many people don't entirely understand what he stands for, of worshipping growth. They worship the altar of growth, and clearly Graham wasn't a guy who said that. In fact, the approaches are different. Buffett buys really high quality businesses at a fair price and watches the business grow over time. What Graham said was, you got to focus on understanding, the balance sheet, the nature of the business, and understand what the business is intrinsically worth, what you're paying for it, and if there's a big gap between the two, and you're paying much less for it than it's intrinsically worth, then you go out and buy it.
Let's take a look at these tenets of investing by Grahamism. Let's look at one of them. The first one, which I find very absorbing. Obvious prospects for growth do not translate into obvious profits for investors.
God, are you taking a dig at me?
No, not really.
I learned this the hard way in my life, and it's sad because this is, the saga of Infosys, which I've owned for many, many years. So, if you had owned Infosys, let's say, sometime around the turn of the decade, when there was a huge amount of enthusiasm about the growth prospects for that company and how well it would do going forward, then you felt that this was the right place to be, and all the growth that was expected came through. Management delivered. The business had a tremendous time in terms of maintaining and extending its leadership, great quality balance sheet. Yet, if someone had bought Infosys in the first quarter of 2000 and held it for 8 years, and another guy had gone to the post office and opened a post office savings deposit, guess who would have done better?
Hard to believe, but what is the lesson that you learned from that?
And the lesson is that at the point at which you enter, you've got to be very conscious of the price you pay for the growth that you're going to get. And if you don't relate the two, in other words, the multiple that you're paying, whether it's a cash flow multiple or an earnings multiple, for the growth that you're going to get in future, that you expect to get, then you can be in for a really nasty surprise if the entry price or the entry multiple is way too aggressive.
But it comes back to the same thing that I think they repeated in every lecture and every forget it, is margin of safety, the three most important words in investing. How does that protect you, Chetan?
Margin of safety is something like a bridge, and this example has been given that it's like a bridge. You engineer a bridge, you design a bridge so that it carries a far greater load than what it is designed for. And essentially, margin of safety, when you are buying something, whichever way you define intrinsic value, if you think that it is worth something, you can pay a lot less for it, you have built in a margin of safety. This is in case your calculation of intrinsic value is wrong, your expectations are wrong, they do not materialize. Secondly, it is the difference, it is the return that you will expect to get, because only when you buy something at a discount, assuming the intrinsic value doesn't grow, only if you buy something at a discount can you hope to make some sort of a return.
The margin of safety that comes about when you buy a stock is also very important at the behavioral level. So we buy a stock at a particular price, and then, as we all know, the market is like a roller coaster. It goes up and it goes down, and most of us, we make serious mistakes at those high and low points, or what you can call greed and fear. And one of the ways you can be a guy who really benefits from the compounding effect of owning a decent business is that you allow yourself not to get rattled by greed and fear. And you can only do that if you really
Understand the
bet with
company.
a significant margin of safety.
You may